Hi there. My name is Jason Van Dyne, and I'm the president of AQuest Wealth and Tax Strategies. And so we're going to be here today to talk about just what's going on. We're going to look at the market and the economy from three different ways. First, from an economic perspective, we'll talk a little bit about recession and what that might look like. Secondly, we'll talk about the stock market, how the economy is affecting that. Then we'll talk about the bond market, which is actually usually very boring, but has been very dynamic lately. And then we've got some elections coming up. So although they're not what most people would consider, I don't think the big one, the midterms are going to probably matter because of the House and as well as the Senate, because they're so close and about the potential to flipping. So we're going to look at it from those four perspectives. And I think that it is, we're all crazy for being here because it is an absolutely beautiful summer day here in Michigan. So I'm going to do my best. I've been doing a lot better lately to try and keep this as close to 20 minutes as I possibly can. With that, let's talk about the economy first. So I think the economy, I don't want to say has been a challenge lately, but as you look at the stock and bond market in your portfolios and everything that you see and hear on TV is about recession and raising interest rates and all of these huge problems. So I'd like to comment on that a little bit more with this slide. So as you can see here, these are the economic forecasts made by LPL. The LPL has actually reduced their forecast a little bit here recently. But as you can see, they're still fairly robust. I mean, the LPL is projecting, you can see the United States growth, right here in 2022. So they're anticipating year over year that our GDP still grows around 2%, maybe a little bit more. That's not that bad. I mean, Trump did some stuff to kind of boost the economy a little bit, with some stimulus spending as well as tax cuts. But short of that, I mean, the U.S. economy has been doing in good years 2 to 2.5 GDP for a while now. As you can see, even the Eurozone looks surprisingly good, and advanced and emerging markets. Now, emerging markets are a lot lower than they usually are. We'll talk about that. A lot of what we're doing with our interest rates is raising the dollar up quite a bit, and a strong dollar is generally bad for them. But as people talk about a recession, a recession is the common definition for it is 2 quarters of negative GDP. Well, we're there. We've had 2 quarters of negative GDP, but I know a lot of the people on this on the webinar, a lot of the names look familiar, although some don't, and a lot of people, we usually get several hundred people to watch on the replay. So I can tell you, none of our clients are really doing poorly. I don't think I've talked with literally one person this year that has said, "I'm running out of money. I can't find a job. Things are really tight." I think people complain about inflation more than it actually affects them, quite frankly. Not to say that it doesn't affect anyone. I know people on the lower end of the socioeconomic spectrum, and it affects them a lot. Some of our seniors that are on fixed income, in the country, I know it affects them a lot. So I don't want to discount it, but from our client perspective, and it's our clients that are my first order of business. I don't really see our clients having that many issues so far. So it's hard for me when people say we're in a recession, and people ask me, are we in a recession? And so the Department of Labor has yet to say that we are. So technically that means we are not. But also if GDP is growing instead of shrinking, and unemployment just went from 3.6 to 3.5% last month, and that is with 500,000 new jobs, which is a ton. About 140, 160,000 is a little closer to normal. 250,000 is usually good for the month. Last month, we had 500,000 new jobs created, and the unemployment went down from 3.6 to 3.5. If you have that, plus still pretty low interest rates and a growing GDP, I think we'd be hard pressed to say that we're in a recession. I think that one of the things that's going to keep us out of recession is spending. So I do think consumer spending is probably going to slow down. A lot of things are affecting that. People banked a lot of money during the COVID times. No one was doing anything. So all of the money we would otherwise spend on going out and doing fun stuff and sporting events and concerts and trips and out to eat, all that money went in the bank, plus some stimulus money. So kind of in addition to an increased natural savings rate because of less spending for doing less during COVID, there was also a lot of government stimulus that money went right into the bank. So even though inflation is eating away at people's purchasing power a bit, also most people are getting raises, although not quite at the pace of inflation. And in addition to that, we have $3 trillion of excess cash. in savings accounts and checking accounts as an American public than we had before the pandemic. So even as inflation eats away at our purchasing power, what people are doing is they're spending some of their savings. Now, people with no savings, of course, that's a problem. The people on the a little bit lower end are getting hurt, as it seems like they always are, disproportionately. And again, I definitely feel bad for them, but from our client perspective, again, I think that what's going to protect us from a big recession is $3 trillion. I mean, that's a reasonable part of like the entire U.S. economy. So I think that if you look at where people are from their debt to service ratio, which is what the slide shows, and their financial obligations, which is things like groceries and car payments and house payment and just living expenses, we are in a very, very strong position. The U.S. delevered a lot. Meaning they don't have anywhere near as much debt. That's the debt service ratio as a percentage of income. That's come down a lot, like a third from the big downturn we had in 07 and 08. Because everyone that got scared of debt, so they've been paying it off aggressively. Their incomes have gone up because of low unemployment, and met this person. So their incomes have gone up, their debt has gone down, and their savings is up $3 trillion. And that doesn't include increase in the value of their stock market holdings like 401ks and IRAs and Roth IRAs. That's just cash. It's just cash in their savings account. So it's hard for me to believe that we are in a recession. Again, some people argue we are because of 2 quarters of GDP contraction, but it wasn't a lot. But we have all of these other factors that I think are keeping the economy really strong. I think one other thing that's going to help a lot is what's killing the economy. And if you've been watching my webinars at all for the last year and a half, what I've been saying is the number one thing that's going to kill our economy is interest rates. And interest rates will probably go up as a result of an overheating economy. And that would either be due to fiscal stimulus or just low unemployment. Well, we have both. Plus, we have supply chain issues and we have Russia invading Ukraine, which is jacking up commodity prices. And that has led us, when we talk to bonds, we'll talk about what's happened with bonds, but that's led us to really high interest rates, which is a huge problem. As I've been saying for a year and a half, that's going to be the problem for the economy. And I think it has been. But a lot of that stuff is getting better. So if you look at the chart here, you have ISM services orders backlog. That's just a fancy way to say, how long is it from the time that you order something until the time that you actually get it? And as you can see, that line is coming down a lot. And this is a long graph. So this is not over just a couple of weeks. This is over an 11-year period of time. So you can see that the manufacturing as well as the services backlog has come down quite a bit. Like 15% already, and that's great. I actually anticipate that being down probably 25% in the next 2 months from its peak. So that means the supply chains are getting fixed. Some of that is a little bit less purchasing. During the pandemic, we switched from going out to eat, concerts, and travel to my house stinks, my furniture stinks, I need a new TV. So we went from buying services to buying goods, and there was no room for that in our supply chain. You throw in China's zero COVID policy, which shuts down entire chunks of their geographical, country as well as their economy, and our shift to goods instead of services, that really killed the supply chain, and that causes a lot of inflation. And that's getting better, and I think it will be a lot better. If you look at like PC makers, for example, they're getting killed because no one's buying computers anymore because they bought them all a year and a half ago when they realized they needed a new computer at home to work from home. So like demand for computers and a ton of other physical goods are way down. In addition to that, inflation is coming down. So I think I like this chart. It doesn't just talk about inflation, but it talks about what maybe we could look at as a leading indicator of what inflation will look like. So as you can see in blue, it's the New York Fed Supply Chain Pressure Index. And then in the orange, which is what we just talked about, and the orange is inflation, right? CPI, the Consumer Price Index. Those lines follow each other pretty closely, and it's usually the blue line that goes first. So as you can see, if I can find my cursor here, if you can see right here, right, this shot way up in COVID, right? So this said, there's some huge supply chain problems. Then they got a little bit better, and then they shot up. Well, look at what happened to inflation at the same time. Because if goods cost more, if shipping stuff costs a lot more, like 10 times more, the cost of goods is going to go up if raw materials are going up. Well, look how much that's come down already, just in the last couple of months. So, and you can see CPI is starting to peak. The CPI number came out yesterday. It looks great. Hopefully it shows the Federal Reserve that we are in fact coming out of the hyperinflation. Well, hyperinflation's, Brazil at 50%, but for us, it's a lot of inflation that we had, at 8 or 9%. So inflation is coming down. The PPI numbers came out today. So that's kind of like inflation for manufacturing companies. And that was actually down. It didn't just decelerate, which is grow less slowly. It actually went down. That was a big surprise. We thought it would just decelerate, but it didn't. It actually went down. That's why the stock market's up again today. I was up big yesterday on the CPI numbers. So hopefully what that means is inflation has peaked. It's going to be coming down a bit. I mean, those of us that have gas in our cars, right, went from $5 to a little bit under 4. I think that might get a little worse here in the next couple of months before it gets better around Thanksgiving. But I don't think it'll go up to back up to $5 or $6 a gallon. So hopefully inflation has peaked. As a result of that, what has peaked is the Federal Reserve raising rates. So hopefully they cool it on raising rates a little bit, and as a result of that, the market can kind of get a little breathing room and can get back to mid to high single-digit growth here over the next couple of years. So how does that affect the stock market? So I think the stock market, if we had done this seminar, a month and a half ago, 2 months ago, I would have said the stock market has a lot of room for upside. For those of you who have been watching these for a while, in the beginning of the year, I said, I think the stock market's overvalued at least 20%, and it's going to have to come down. That turned out to be about right. And I thought and this is public, you could check our YouTube or our blog where we post this. I said, I think the stock market's going to have to come down 20%. What my hope was that interest rates would go up slowly throughout the year. That did not happen. They went up very drastically. But my hope was that interest rates would go up slowly. They would end the year at 2.2 to 2.5, although they're only at 2.8 today, so they're not that far out of the high end of that range. But they had gone up to 3.5. So my hope was that interest rates would go up slowly, and that what's something called the PE ratio, which for those of you who have been watching these for a while, but for those of you who don't, it's the price of a stock divided by the earnings, which is another word for profit. So if you divide the price of a share of a stock by its earnings, you get the PE ratio. Well, the PE ratio is usually around 15 to 17. It was 21 at the beginning of the year. It's just too high. Now, there's some reasons that you can support that, and part of those reasons were interest rates were really low. And I thought, okay, interest rates will come up a little bit. That's a little bit historically high. And my guess was the stock market was going to be even to down 10%, but that companies were going to make 10% more profit. And that's how we eat into the 20, right? If the stock market was even to down 10 and companies' profits were up 10, that would shrink the PE ratio, right, from the stock market being overvalued 20% to somewhere between 0 to 10. So either it would be fairly valued or down 10. And that is really, I mean, I looked like an idiot 3 months ago because that did not happen, right? Everything was much worse than that. But as the market has come back a little bit, that's about in line. So right now, the stock market, the S&P 500 is down 12%. And earnings on companies are up about 9. And I would assume by the end of the year, that's going to be at least 10. So I think that what you'll see is that as the price to earnings ratio shrinks a little bit, that the stock market is what you'd consider fairly valued. I would consider the stock market today fairly valued. The PE ratio is probably around 17. It was 16.8, I know, the other day. We've had a couple of up days, so it's probably a little bit over 17 now. We're right at 17. And that's pretty normal. So that's, I think, a fairly valued number. As we start to get inflation down, which we can talk about that on the next slide, as inflation goes higher, as you can see here to the right, it means typically you can have a higher PE ratio. So higher valuations, another word for valuations is the ratio, that PE ratio. So you can have higher valuations on the stock market if inflation is lower. So right now, I think we're fairly valued, but as companies continue to make more money over, let's say, the next 6 to 12 months, and as inflation comes down, I think that you could see some relatively substantial growth to get back to where we were at the beginning of the year. But that's a lot more from now. That's another 15 or 20% from where we are today. And I don't think that's impossible, over the next year or so to maybe get to, assuming that the rate hikes that the Fed does creates a little bit more of a soft landing where inflation does continue to come down, CPI and PPI. By the spring, that is way down into maybe like the 4 to 4.5, 5% range, but trending down, right? Because you'll have a couple high months from this summer still. But where you've got maybe 4 to 5% and trending down, then if the stock market, is fairly valued now, I think that it's very reasonable to see some pretty substantial growth at that point. Another reason that you can get that growth is our next slide, is that this is, and I don't think people really realize this, quite frankly, it's kind of a surprise to me when I look at it. Companies are making a lot of money, like a lot. So as you can see here in 2019, that technical term, a lot. As you can see here in 2019, the earnings per share, so the profit per share of a company on average divided by the whole S&P 500, so the 500 biggest stocks in the country. In 2019, it was only $160, which was good at the time, actually. It was really good. That has grown all the way to this year. We think we're going to be at 225. That is gigantic growth. So when people say, oh, the stock market's up so much, it's too much government stimulus, it can't possibly stay like that. I don't know that that's right. Because if you went from 160 to 225, that's what, 35 or 40% growth in the profitability of all companies throughout. I mean, so you're talking all, healthcare, IT, automotive, consumer discretionary, materials, energy. The average earnings per share of all of the sectors in the United States is up by that much in just 3 years. So the stock market can, and again, that's where that price to earnings ratio comes in. The stock market is not overvalued right now, I don't think. I thought it was at the beginning of the year, but I don't think it is now. The problem at the beginning of the year was interest rates were also zero, which we're going to talk about when we talk about bonds in a second. So, we weren't super interested in buying bonds either. The stock market was overvalued. So again, where do you go? Where do you put your money? So it was a little bit of a challenge before, but now it's not as much. We're shying away from bonds. We're definitely shying away from emerging markets. Again, as our dollar goes up, it really hurts emerging markets a lot. So we're shying away from them a little bit, but where the stock market is today, between 42 and 4,300 is very fairly valued based on the inflation rate that we have today, the profit, right, the earnings of the companies today, and I think where interest rates are, right? Those are probably the three things that I look at and say, well, now, so I think that those are the three things that I look at, and I think that it proves that the companies are fairly valued. So again, here's the average consensus estimate is about, S&P fair value, will be 4,300 to 4,400, so a little higher than we have now, with S&P earnings at 225, and I don't see any reason why that can't happen. Now, again, we started the year at almost 4,800, so we'd still be, a good 10% below where we started the year. But those ranges are very reasonable. It means a little bit more in earnings, even from where we are today, or a little bit more growth in the market. And again, if you see interest rates inflation start to come down by the end of the year, that will support even expanding multiples a little bit more. So LPL in January had this number, this 43 to 4,400, and they had it at 49 to 5,100. So they've drastically changed their end of the year estimates. They did that a couple months ago. To that, and it looks like that is probably going to be about right for where we are today. So let's talk about bonds. As all of you know, anyone here who has bonds in their portfolio, which is almost everyone, bonds had the worst first quarter in the history of the United States of America. No exaggeration, no hyperbole, in the United States, the history. So they're bad. They were bad. As interest rates go up, bonds go down, right? Their valuations just got killed. So what I'm going to say is I'm going to show you this slide. I think it's a little much, quite frankly. I think it's tough to read and tough to look at. But I think that the one of the big issues with bonds a couple of years ago, well, the beginning of the year, was as interest rates go up, or as they were there, the interest rates were basically at zero. So you had what's called like kind of what we call the Tina effect. Like there is no alternative. You didn't want to buy bonds at 0%. Right, but you didn't want to buy the stock market at 20% overvalued, and what else was there? Right, so we did a very aggressive rebalancing. We tried to do value stocks instead of growth. We tried to do short-term bonds instead of long. I mean, there was things that we tried to do, but you can only do so much in this market, where both the stock market at one point was down 25% and the bond market was down 13%. There's just kind of nowhere to hide, I think, in those environments. So now though, that interest rates have gone up, yes, bonds have come down, but that's also shrunk that potential PE. You remember earlier I said 21 was actually not that far out of bounds. I knew I'd have to correct as interest rates went up, but the reason 21 was okay at the time was because as interest rates are low, the TINA effect comes in. You don't want to buy bonds, right? Unless you're just using them as a savings account, basically to either dollar cost average into or out of, or to rebalance into or out of, which is how we've been predominantly using them. But there was no alternative. You're not going to buy bonds at zero, so you just bought stock, right? Even though it was high. Well, now that interest rates are going up, the alternatives to the stock market look better, right? So they're not 0% anymore. Bonds are actually giving a pretty fair yield. And that's kind of what this is showing, is yields across the sectors are better. That also means that bond values are low. It's probably a good time to buy some bonds if you don't have any in your portfolio yet. But it was that is what is driving the shrink. Again, inflation, just a reversion to the mean, as well as the alternatives now. So there is no TINA effect. There is an alternative to the stock market, and it's not that bad, right? Because the bonds are now paying a lot more than they were before, and they're at a discount, so you can buy them for a little bit of a deal. So I think that's a big part of the reason that the stock market had to come down from 21 to 17. Again, we expected that, although it happened way faster than we thought. Luckily, it's mitigating a little bit more. The other thing I'm happy about bonds is well, before I go on, let me talk yields. The 10-year treasury is what matters. What the Federal Reserve does on a day-to-day basis doesn't really much matter. It affects it a little bit, but the 10-year treasury is really what to watch. The 10-year treasury went from 1.3 at the beginning of the year to 3.5 in April. I mean, it's the highest. It's the biggest change it's ever made, which killed bonds, because as interest rates go up, the bond prices go down. What was the worst thing about that actually was bonds didn't act as a diversifier. So what this chart shows is if the blue lines go above that center horizontal line here, it means that bonds are not doing their job. And it means that as stocks either go up, bonds also go up, or as stocks go down, bonds also go down. So they are not acting as an anchor to the portfolio and as a diversifier to stocks. As you can see, going all the way back, this is a 22-year chart. Almost always is it down here, right? It's almost always a diversifier, which means as the stock market goes down, the bond market goes up. It did not act like that this time. So as the stock market was going down, you'd think, okay, well, we're protecting you in bonds. Well, in April 1st, bonds were down when we went to go rebalance, and bonds were down 10% and stocks were down 12%. So again, that's why there was just no place to hide, and there was no way that it was one of the smallest rebalances we've ever done, and there was just everything was down, right? Crypto's down, everything but your house, right? Gold was even down, which usually in inflationary environments they do well. Stocks, bonds, crypto, everything, right? Commodities did well. Commodities did okay, and energy did really well. But that was it. You're not gonna have your whole portfolio in something that was worth negative $36 a barrel oil, less than 2 years ago, or a little bit more than 2 years ago now. So what's nice is if you could see this little blip right here, right? In finance, we get excited about these little blips. This little blip right here, what that's showing is recently, right, the last handful of months, bonds have gone back to their typical role, which is they are a hedge against what the stock market's doing. They're a diversifier. Bonds have done better as interest rates went from 3.5 in April down to about 2.8. I didn't look today, 2.8, 2.9. As those interest rates have come down, the bonds have come back up, plus they're earning interest every month. So they're starting to do their job again, which is why we are way more excited about bonds. Interest rates are higher, yields are higher, and prices are down. So as far as they're acting as a diversifier. So bonds today, I've been saying for 3 years, we did not like bonds. For the last 3 months, I've been saying we like bonds. So we are bringing them back in the portfolios in a big way, where we had tried to stay away from them in a lot of ways previously. So how am I doing on time? I'm over the 20 minutes already. We'll end on the election. So I think everyone is interested, depending on your political leaning. So what we're going to do is just talk about this as I end here. So I think that again, kind of the markets hate uncertainty. But what does that mean? What that means is we don't like not knowing what's going to happen. Quite frankly, everyone thinks they know what they think they know what is going to happen now, which is that the House of Representatives is going to go to the Republicans. The Senate might go to Republicans, and depending on how you feel about Manchin and Sinema, it already is. As a comment I hear a lot. And then, of course, it is not a presidential election cycle, so the presidency will remain, of course, in Democrat hands for now. So I'm not here to say whether that's good or bad, because you'll always upset the majority of your audience, or at least close to half. So what I will say is if you look at this, one of the best scenarios under a Democratic president is Republican control of Congress, right? So the S&P is up an average of 16.3% when the president is a Democrat and when Congress is Republican. And the reason for that is nothing gets done, right? No party can kind of get too extreme, right? And they can't do a lot of the stuff that they want. And the market likes that. They like that stability. Companies can invest money knowing nothing's really going to change, or that, they can invest. I mean, think of some of these companies are investing, like semiconductors right now are investing 40, 50, 60 billion dollars to build new plants. Automotive companies here in Michigan are doing that in the transition to EVs. These companies are making tens and tens of billions of dollars of investment, and they have to kind of know what's going to happen. So big changes are bad. Split government is good because no one can get extreme, and the market likes that. Now you can argue if that's good for the country, because arguably nothing gets done and we don't move forward as a nation, but you also don't move backward depending on your perspective. Also, what I'd like to add is if Democrats do hold on to the Senate but lose the House, which is the second most likely scenario, based on I think it's the Nate Silver's company, something 39. If Democrats hold on to the Senate, obviously Biden's going to be there, but they lose the House, that the next year of growth in the S&P 500 on average 13.6. So what the election cycles are telling us is one of the best things that can happen is the House can go to the Republicans. Now, I know for the Democrats out there, you're going to be all upset and say, we don't like that. And that's okay. We're not here to say whether that's good for the society or bad for our American society. But what I think my job is to figure out what is good for our portfolios. And if Republicans took over both, right, even as a Democrat, I think you might worry about society collapsing, but your portfolio will probably look okay. And even if they take the House only, your portfolio still looks okay, with between an average of 13 and 16.3% growth the year after those elections. So something that we're doing, you're all going to get invitations in the next couple of weeks, but we are doing our first ever financial tax, estate planning, and stock market workshop. And how it's going to work is different than what we've ever done. We're going to offer different times between 10:30 and 2 o'clock-ish in the afternoon, with lunch in the middle, where we're going. Now, of course, you as clients all have access to these resources, but where we're going to discuss, like Jonathan will be talking about certain tax issues, specifically Roth conversions. Joe Carassi is an estate planning attorney that we often work with. He's going to talk about wills and trust, what they are, and why you should have one of the other. And we're bringing in a guest speaker to talk about kind of tax efficient investing. And I'm probably going to talk about like whether or not this is a Goldilocks time to do Roth conversions, and if you do them, how that could potentially create a tax-free retirement or Social Security for you. So those are going to be the topics. And how we're going to do it again is all of you are invited. You can always come at any time, but we're using it as more of a client acquisition tool. So one of the things I hear about the most is, hey, we've referred 4 people to you. Have they called? And on almost every case, the answer is no. So if you know anyone who either has been thinking about hiring a financial advisor, or who you'd like to introduce to AQuest Wealth, in an easy kind of low pressure way, you can come. You can go to 1, 2, 3, or 4. Do whatever you want. It's not something where you have to be here the whole day. If you're going to come to 1 or 2 in the morning, grab lunch with us. If you're going to come to some in the afternoon, come a little bit ahead of time and grab lunch. We rented out the Rochester Mills, which is just behind our building here in Rochester. So again, anyone that you think might be able to benefit from our services, we would love to see you and bring them, to something like this. And of course, if you want to come by yourself, feel free to do so. We'd love to see you, but you always have access to those resources as clients of AQuest Wealth and Tax. So thank you for everyone for sticking around. If you have any questions, don't hesitate to reach out to me personally. Even if we don't work together, I'm happy to answer any of your questions. Reach out if you work with any of the other AQuest advisors, feel free to reach out to them. And again, thank you very much for your time, and we will all talk soon.